Advisory services offered through VestGen Advisors, LLC, an SEC-registered investment advisor. Securities offered through Private Client Services, LLC, member FINRA and SIPC. Private Client Services and VestGen Advisors, LLC are unaffiliated entities. Any information discussed does not constitute investment advice. VestGen Advisors and Private Client Services do not offer tax or legal advice. People of Chicago, welcome to In the Know Radio with Craig Bolanos, co-founder and wealth advisor at VestGen Wealth Partners. You want help from someone you can trust, someone who knows what it takes to get retired and stay retired. Today, Craig's going to teach you what you need to know. So get ready to learn something that could change your life. Get connected to the show by calling 833-964-PLAN or go to getretiredstayretired.com. And now, here's Craig Bolanos.
Hey, good morning and a very happy Sunday to you. We're again in the studio giving you sincere and actionable ideas because we want you to win. And I define winning as improving the lives of yourself and your loved ones financially. Because you know what? When you're doing better financially, you tend to worry less. And if you worry less, you're preordained to live a little bit more. And that's what financial peace is all about. So you know the number, 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. So you know what? Is valuation a problem for Mr. Market? Mr. Market being the stock market, yes or no? We got to talk about that, and I think we got to talk about it right now. Yeah, had some down days this past week. Everyone know it. Everyone felt it. Everyone saw it. You saw the declines after the big run-up you had in Oracle and some of the AI enthusiasm stocks. Is the end near? No, it's probably not, but is valuation a problem? Because that's ultimately what we need to pay attention to. Because remember, when markets correct, they're correcting for valuation. Well, listen, famed hedge fund manager, that's not me. I don't run a hedge fund, but his name was David Tepper. He made big news. It was big news recently when he said, hey, he basically wants to stay in the market because he too knows the slogan I know, which is you don't want to fight the Fed. And when the Fed is cutting rates, especially when the Fed is cutting rates in a non-recessionary environment, history tends to be on your side that prices are going to continue to rise. But is simply not fight the Fed and new highs make new highs and don't fight the tape, are those good enough slogans? I think we should go further because we should be students of the market, which we are at VestGen Wealth Partners. So when I think about valuation, when I think about the market, and there's lots of different markets, there's the small cap market, the mid cap market, the large cap market, but the market's just a general vernacular for, say, the S&P 500. And when I think about the S&P 500, it's incredibly important to recognize that the ballooning influence of mega cap stocks has already altered some of the normal ranges. I mean, consider this. From mid-2015 through mid-2018, the PE multiples of just the SPDR, right? That's the ETF that tracks the market cap weighting of the S&P 500, and RSP, which is an ETF that's an equally weighted version. The equally weighted version is, again, every stock represents 1/500th of the index. That's the equal weight version. The cap weighted version is that where the largest stocks control or influence the markets the most. And what I want you to know is if you go back and look at that period, both of those indices, the cap-weighted and equal weight version of the S&P, they were in lockstep with one another. But that all changed. It changed back in 2018. It's the famous FANG stocks. Facebook, which is now Meta, Amazon, Apple, Netflix, and Google, began to balloon in market cap. And as those stocks ballooned in market cap, they became a larger and larger influence on the S&P. And from 2018 until now, the gap between cap weighted and equal weighted, well, I got to tell you, it's about as large as it's ever been. Oh, yeah. I mean, the cap-weighted S&P trades at 23 times earnings. The equal-weight S&P trades at a very soft, very low, much more palatable 18 times earnings. So what is your takeaway as we nerd out and talk valuations? If you're just tuning in, I'm talking about the fact that everybody wants to know, is valuation a problem in the market? Why would you care about valuation? Because you don't want your 401k to turn into a 301k, worse yet, a 201k. Why does valuation matter? You don't want your 529 plan to go down and become a 329 plan by hitting a market loss. So all I'm expressing is that these mega cap tech stocks, which we all know and love and all of us have embraced and invested in, they are skewing the data a bit because of how much they represent. So what are your takeaways right now with the cap-weighted S&P trading at such a high multiple compared to the equal weight version of the S&P? Well, takeaway number one is this. The rest of the stock market is not at new valuation highs. But because of AI enthusiasm, the S&P 500 is, right? And while the S&P 500 is trading at new highs on valuations, you've got things like the equal weight version, RSP. It's got a lot more room to run before it hits its previous highs. So if you're at all concerned about valuation, you're at all concerned about those constraints, I think you've got to think intelligently about if you want to stay in the run hot index or you want to stay in the equal weight index. I think takeaway number two, as we talk about, is valuation a concern for the market, is just know that if you're in the cap weighted version of the S&P 500, you are very, very reliant upon artificial intelligence stocks. Now, that's not something you didn't already know inherently, but remember the valuation gap between the S&P 500 at 23 times earnings and the S&P equal weight at 18 times earnings. It is large as it's ever been. And that really matters because it underscores that if sentiment towards AI in any way were to sour for any reason, then the S&P 500, well, boy, that thing could fall more than 20% before it's in line with its equal weight and other market indices. Now, I want to be clear. I'm not saying that's going to happen in any way, shape, or form. I'm just pointing to the fact that the numbers don't lie. So if you're in the S&P 500 as your main investment, you are absolutely married to AI enthusiasm right now. So that means it better keep going. Takeaway number three. Talking about valuation of the market. Is there a valuation problem? History in any way, shape, or form does not imply that AI-related tech is going to hold up in a bad market. I want to make sure you know that. History does not imply that AI tech is necessarily going to hold up in a bad market. I mean, think about what happened in early 2022. So I think the bottom line for everybody is this. I've always said, and I still maintain, that valuations by themselves are not a reason to get into, and valuations by themselves are not a reason to get out of or exit markets. Valuations don't make stocks fall. Events do. But stretched valuations can give people an idea of how far stocks could fall. And the reality is, the cap-weighted version of the S&P 500 is stretched on valuation, largely because of AI enthusiasm. And that statement is totally fine so long as artificial intelligence continues to not disappoint and broader economic data stays solid. But if AI enthusiasm wanes or slow down fears rise, the S&P 500 cap-weighted version can fall a long way, even if the rest of the market relatively hangs in there. All right. What do you do with that information? Well, if you want to get retired and stay retired, you need to pay attention to those things we call ADRs, your allocation, your diversification, your rebalancing protocols, and your security selection. And it's that last one, security selection, that we're discussing. because being just in the S&P 500 is no longer adequate diversification for the long term based on how the largest stocks are having the biggest outsized influence. And the reason that should matter so much to you is one of the things that you need to tackle if you're going into retirement is you need to tackle what I call sequence of return risk. Because sequence of return risk, kind of like inflation, which is the silent killer, sequence of return risk is the ultimate killer. It's an absolute nightmare, the type of nightmare that can jolt recent retirees awake at night. And it's what happens when you hit a massive air pocket. So we're going to talk about what the strategies are that you need to be deploying to help reduce sequence of return risk and how you too can use intelligent security selection, which might just be diversifying beyond the cap-weighted S&P 500 so you too cannot survive retirement, but you can thrive in retirement. Listen, guys, if you want to learn more, go out to our website. GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. Or pick up the phone and give us a holler. 833-964-PLAN. 833-964-PLAN. We want to hear from you. We want to connect with you. We're coming into the fourth quarter, everybody. 9 months of the year is going to be in the books. Lots of people have experienced double-digit gains in their portfolio. What are you doing to secure the next 90 days? And then what are you doing to make sure you put yourself in a position to win in 26? And then how are you going to secure the next 19 years? All of that are hints of which we're going to give you throughout today's program. I think it's information that you can't afford to miss. So in the meantime, if you too want to get retired and stay retired, go to our website, GetRetiredStayRetired.com, 833-964-PLAN. And when we come back, what you know and what you think you only know about sequence of return risk and the solutions to it. Craig Bolanos, in the know, VestGen Wealth Partners, AM 560, The Answer.
You want more in the know radio? You want more in the know radio? You can't handle more in the know radio. Okay, yeah, you can. And it's on AM 560, The Answer. Welcome back. Here's more with Craig.
Oh my, it is the nightmare. It is worse than the boogeyman. It is worse than the ghosts and goblins and ghouls that come out in the month of October, those that live under your bed or in your closet that cause you to sleep with one eye open. What am I talking about that is so earth-shattering, so disastrous? It is the concept of sequence of return risk. And who is in the crosshairs of sequence of return risk? It's someone who is about to retire or someone who just retired recently. And what is sequence of return risk? Well, it goes something like this. You had just spent a lifetime saving money, being responsible, feeding your 401k, feeding your IRAs. And then right as you're about to retire or just after you retire, the stock market goes in a free fall. You think it can't happen? Ask anybody who retired at or near March 10th of 2000. Ask anybody who retired at or near October 7th of 2007. Ask somebody who initially retired at or around March 9th of 2020. I can give you even more dates, but this is real. These things happen, and you need to protect yourself from sequence of return risk. And now I know it seems ill-fated. The economy's humming. Things are doing well. Unemployment is elevated, but still incredibly low. Stock markets are barely off of all-time highs. People have double-digit returns. So it's challenging to envision a market correction coming. But remember, the market does whatever it needs to do to confuse as many people as it can at any given point in time. That doesn't mean I predict there's something bad looming. It's just I want to talk about sequence of return risk as it relates to things like the S&P 500, given you heard me say for 12 minutes in that last segment that the valuations at 23 times earnings for the cap-weighted indice versus 18 times earnings for the equal-weight indice just makes everybody take a bit of a pause. So very specifically, sequence of return risk is when you have these early losses in the first year, 2 years, or 3 years of retirement. And why is it so dastardly? Why is it so difficult? The downside of an ill-timed market downturn, what makes it so acute, is you could get this 1-2 punch. You're selling stocks in the early years of retirement as share prices are declining in value. And when you do that, you reduce the ability for your portfolio to recover. And think about this. When you're growing your capital over time, it's about the average annual rate of return that you receive. Once you are retired, it is about the sequence through which you experience those returns. You could have two investors, both who earn, say, 9% per year over the long term. But if investor A benefits from retiring into a bull market where the stock market goes higher each year for the first 3 years, while investor B, who has the same 9% average rate of return through their retirement, has the exact opposite, they retire into a 3-year market decline, I got news. Investor B might run out of money unless they do something. And what do they got to do? They got to plan. They got to expect the unexpected. They need to have preparedness and flexibility. So what are some of the things that you should do? Well, first, this is why I tell everybody. Target date funds are probably fine for growing your portfolio. Diversified portfolios that are a mixture of stocks and bonds are fine, but once you're retired, you can't afford to take withdrawals from a target portfolio, which is a mixture of stocks and bonds, because every single month you're selling a portion of your stocks and bonds. Likewise, if you've got money in a 401k, 403b that does withdrawals on a pro rata basis, meaning every dollar you withdraw each month, some comes from the bond portion of the account, some comes from the stock portion of the account, that is a no-go if you're in a down market. So one of the ways you can avoid that is do the so-called bucket strategy. And we've talked about this time and time again. We've talked about the 3 pillars of retirement income. But that bucket strategy is to make sure you've got a bucket of money. I call it your cash flow reserve account that's got enough treasuries, agency-backed, asset-backed, other bonds in there that you can live off of for a period of 1 to 5 years, depending on economic conditions, so that you can allow your second bucket, which is your growth and income bucket, your total return bucket, along with your third bucket, which is your perennial growth bucket, to appreciate over time. So the bucket of money strategy gets it done. In addition to the bucket of money strategy, one of the ways that I argue you could solve for retirement today is, has anybody seen how good interest rates still are? Yes, we just had our first interest rate cut in September in what feels like the first cut in 9 to 10 months. That's because it was. But interest rates are still high, everybody. Have you seen the type of yields you can build on bond portfolios? Have you seen the types of yields you can get in tax-free munis on the intermediate side of the curve? Have you seen how much cash flow can be generated with various forms of real estate and other credits? So listen, if you've got a big enough nest egg, everybody, you could actually choose not to use the bucket strategy. You could choose just to clip coupons. Because if you have a 3.5% or 4% distribution, but your portfolio is just yielding north of 5%, well, at north of 5%, you can just live off of the income without ever touching the principal. Wouldn't that be nice? It sure is. So all I wanted to say on a Sunday morning is be mindful of something. New highs make new highs. Don't fight the Fed. Don't fight the tape. You have to have a bias to be an investor. You have to have a bias to be long this market today, but you better not get complacent. Because if the only thing you own in your portfolio is the S&P 500 cap weighted indice, you have a valuation problem that hasn't been realized yet, but there will eventually be an event that causes it to be recognized. And when that happens, stretch valuations equal larger declines, and I think that's worrisome. So what do you need to do? You need to get a plan. And once you have a plan, once you have a true retirement income plan, where is my money going to come from? How is that money going to be taxed? Based on where that money is going to come from, how that money is going to be taxed, combined with when exactly I'm using it, then and only then are you in a position to begin to build out investment portfolios to fit what you specifically need. And then you can combine that into the 3 pillars of retirement income, which is, of course, to make sure you pay attention to the fact that capital matters, because capital has always mattered. Once you are retired, you can't afford to get blown up. Number 2, you better have a plan to generate sufficient portfolio income. That's interest, dividends, payments to make sure that you are cash flowing retirement. And of course, do not forget, pillar number 3, you've got to have a way to grow your capital base in order to grow your income, because you've got to outrun the silent killer, which is hypertension. And whether we're doing it in a cash flow model, whether we're doing it in a bucket strategy, whether we're doing it in a combination hybrid plan, what matters is that you have a plan that's systematic, repeatable, followed by a robust process that is tested in the trenches. That is what we do. And gosh darn it, I got to tell you, we do it pretty well at VestGen Wealth Partners. So pick up the phone, give us a call, 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. Now, on this note, please recall, it is last call for income. There are tax equivalent yields near 7%, in the municipal bond space. There is tremendous FFO and modified funds from operation that can be done in various forms of passive income. There is a tremendous opportunity for those who are willing to deposit some of their money and be a senior secured first lien holder with floating rates in the world of private credit, in the right sponsors, in the right amounts for qualified investors. There's just so many solutions out there. And even if you wanted to keep it super simple, guys, you can even buy a multi-year guaranteed annuity still at 5.5% guaranteed each year for 5 years. Boy, that's not hard. I think it'll allow you to at least keep your purchasing power and outrun inflation. Our job is to listen to you. Our job is to study every single day. Our job is to be vigilant and never complacent so you too can thrive, not survive in retirement. I'm Craig Bolanos, co-founder, wealth manager at VestGen Wealth Partners. We exist to reinstill faith and confidence with people just like you who need exactly that, faith and confidence in the model of financial advice, because it's an investment thing, a cash flow thing, a tax thing, an estate thing. It's a retiree healthcare thing. It's an everything thing. So connect with us online, getretiredstayretired.com. That's getretiredstayretired.com.
Would you like a dose of knowledge? Good, because Craig is back and about to fill your retirement prescription. Back to In the Know Radio on AM 560. The Answer.
I got to tell you, I am so happy that I got that off my chest. There is not some looming disaster, but I am thrilled that we got to talk about whether or not valuation is a problem and what it means to trade at 23 times earnings versus 18, and what that can mean for those who are looking to hedge out sequence of return risk and some of the strategies that you can use. 833-964-PLAN. That's 833-964-PLAN. go out to our website at getretiredstayretired.com. That brings me to an entirely different subject, but man, it is one that rings home with me. It is something that is so important to everybody. I consider it to be the avalanche issue in American financial planning today. Yeah, that's not drama. I'm serious. It is the avalanche issue in American financial planning. And it is the concept of continuity of care, or what some people refer to as long-term care. So here's what you got to do. Go out to our website right now, getretiredstayretired.com, getretiredstayretired.com. Click on useful guides and download our introduction to long-term care. Download our introduction to long-term care. But now I bring into this studio one of the foremost authorities on long-term care. This is all she does. And because it's all she does, she is narrowing the focus to increase the impact, to give people defined outcomes and solutions custom tailored to them. Jean, thank you for taking the time on a Sunday before kickoff across the country. What I want to hear from you very succinctly is, why do you do what you do for the families you serve across the country?
Why I do what I do, Craig, is because I've had a family experience with long-term care. I've watched what not having long-term care planning can do to a family. I've seen within my own family, my grandmother lose everything, end up on Medicaid, go through the rigors of the Medicaid system, and it broke her heart. She had saved her entire life to leave something, just a little something, to myself and my sister, and she lost everything over the course of a year to a nursing home and died brokenhearted. And I resolved at that point in time that I was not going to let that happen to another family if I had anything to say about it. And that's why I do what I do.
So, Jean, and thank you for giving us a piece of you, a piece of that history. And everyone listening knows our journey between my dad's stroke, my mom's ALS. I mean, all disease is terrible, but things like Lou Gehrig's disease, Parkinson's, Huntington's, it's just awful. That being said, Jean, what are the solutions that we're driving through VestGen Wealth Partners to help families across the country partially insure and hedge out long-term care? Give us a quick nugget or example or two of how we're creating that with success.
There are plans that exist today that didn't exist several years ago that allow for cash payouts as opposed to sending in bills each month to a carrier. You're simply receiving a check in the mail, and these are plans that are funded with anything from a single payment to an annual payment that's guaranteed not to go up. So the problems that we had with long-term care in the past that were increasing premiums over time, the risk of premiums going up over time, that's no longer a problem. We have guaranteed premium plans out there. We no longer have the problem of use it or lose it. We have plans now that have death benefits so that if you don't need the long-term care, your family gets back whatever you put into the plan in the form of a death benefit, a tax-free death benefit. And if you do need long-term care, you get a great multiplier of what you've put into the plan, like I said, in the form of a check each month that you spend as you see fit for your care. You're not sending in bills to a carrier necessarily anymore to get repaid for money you've already spent. You're just getting a check from the carrier and you're spending that money on your care as you see fit. It's simplified to an extreme now.
And Jean, let me pare back a couple of those key points in case people missed it. If you're just tuning in, we're talking about that avalanche issue in American financial planning, which is long-term care. And one of the things that Jean is doing as one of the foremost authorities on this topic is curating solutions for people that answer the vexing questions. Question number one, how can I purchase some form of long-term care without risking premium increases over time? That is now possible by buying a policy in a lump sum, or paying off the policy in a finite number of years. Number two, how do we protect choice? There are too many plans out there that are clumsy and inconvenient where the benefits you receive come from reimbursement, meaning you got to pay you got to come out of pocket for the costs and then get reimbursed. Now, these cash plans, these indemnity plans, as Gene referred to it, you qualify and trigger benefits. The insurance company sends you the cash and you use that right then and there, whether you're hiring a family member, a neighbor, a friend, you have agency, you have control. I think that's critical. Third, I do not like insurance. I like solving problems. And one of the vexing problems with any form of insurance is, what if I invest in coverage and never actually use it? Well, now there are ways that if you buy a long-term care policy, you can ensure that if you never go on claim, you never have to use the benefits. The premiums you paid are going to get refunded into your beneficiary. I think that is huge. Gene, did I get most of it?
You got all of it.
I like that. So, Gene, one of the other considerations that needs to be solved for, and this is so important. I mean, we talked to a family earlier this week about this, I think twice this week. What do you mean about protecting healthy spouse? Because I don't think long-term care is about protecting an inheritance for next gen. I think long-term care is really about preserving choice and protecting healthy spouse. What does that mean to you in today's climate?
What that really means to me is that when you've got a couple together and the couple has enough money that they feel as though they can self-insure, that's probably very true for the first spouse. The first spouse who gets sick is going to get great care because that second spouse is going to drop everything to help care for them. They're going to spend whatever they need to spend to make sure that first spouse who gets sick gets the very best care possible. And they're going to spend what they need to spend to make that happen. But then after that first spouse is gone, now you're left with that second spouse, that survivor that's left, kind of holding the bag on what may not be a huge bag anymore. So now that spouse who's left behind may not have a whole lot left to care for themselves. And their choice may now be limited by the fact that they did everything they needed to do to care for their partner while they were alive.
And Gene, that's just it. I mean, I think if you are married, you have a best friend in life, your husband or your wife, you're doing some form of planning because you need to make sure that the healthy spouse does not end up financially impoverished. I talk about it because it's real. It's in full force and effect all across this country. We see it and we want to cure it. I want to stand against it. I want to protect from spousal impoverishment in married couples if one person gets sick. And you know what? Gosh, I know you do too. So here's how you start that journey. I want you to connect with us online at getretiredstayretired.com. That's getretiredstayretired.com. I want you to download one of our useful guides, such as the publication entitled A Short Intro to Long-Term Care. And then I want you to give us a call, 833-964-PLAN. I want you to schedule a complimentary consultation with myself, with Gene, so you too can get educated, because information is empowering, and then you can curate something that is bespoke and custom tailored to you and your family. All right, you're listening to In the Know, Craig Bolanos on your favorite station, AM 560, The Answer.
It's more In the Know Radio with Craig Bolanos on AM 560 The Answer, where his goal is to pummel you with financial know-how until you say uncle.
You know, there's a looming deadline out there. That looming deadline is October 15th for all of those procrastinators. That's your last time to get that 1040 filed. But what do you need to know about OBA, the One Big Beautiful Bill Act? Well, again, we've talked time and time again that there's a considerable number of changes across a full spectrum of America's institutions and circumstances for individuals. So when you discuss so much of this in the news, things can get lost. And here's a couple of takeaways that you need to think about from OBA. And here are the considerations that maybe, just maybe, ought to be getting implemented. Number one, you know it by now because we connect every week or you see me in the media and other places, that the Tax Cut and Jobs Act rates have been extended. Why do you care? Because you don't want to have your marginal tax bracket go up. Now, there's other things in the OBA bill that end up expiring in 2028 and 2029, but at least the tax rates themselves, the marginal tax rates, are permanent. That's number one. Number two, yes, most people do not itemize. But hey, this $6,000 per year enhanced standard deduction for those who are 65 and older, guys, that is a game changer. That is a game changer. Married couple, you get an enhanced deduction of an additional $12,000. Well, wait, you only get that enhanced deduction if your income, that's your adjusted gross income, qualifies. More on that in our strategy session in a second. Number three, the salt shaker. When they capped the salt shaker at $10,000, I shook my fists at the sky and Cook County. Cook County, that is. Why? I couldn't believe my state and local taxes were going to be capped at 10 grand. Someone send me an hallelujah on a Sunday. The One Big Beautiful Bill Act has quadrupled the salt deduction cap to 40 grand. Oh, thank heavens. But again, you only get the quadruple salt cap deduction if your income is right-sized. Again, that's your AGI. And number four, for anybody who's done super well, for people who have grown their estate, isn't it wonderful news that the estate tax exemption is now $15 million per person? That is way better than what it was going to go back to if we didn't have the OBA, One Big Beautiful Bill Act. Can you imagine $6 million per person? Now, maybe someone out there doesn't care, but I tell you what, if you have a business, you've amassed a large estate, boy, this was a win. So what are the considerations that come from the One Big Beautiful Bill? Well, I think the first is, if you haven't done it yet for 2025, it's not too late to start thinking about what you ought to do for 2026. And that means revisiting your withdrawal strategy. Because I am convinced more than ever that more retirees are going to want to have a blended withdrawal strategy. Blended withdrawal strategy means you're paying attention to your pre-tax, taxable, and post-tax or Roth distributions to engineer a defined outcome on your tax return. Because there are going to be people out there in America who have just slightly too much money and lose their $6,000 per person enhanced senior deduction. There will be people out there in America who have slightly too much income who lose their entire quadruple salt cap deduction. Don't let that be you. How are you not going to let it be you? You're going to get an income plan that's aligned with a tax plan, which means you need to work with a firm that has all of those services under one roof. You know somebody that does. It's us. 833-964-PLAN. 833-964-PLAN. All right, we're talking about the One Big Beautiful Bill Act and considerations that should be obvious by now. And in case they're not, I'm making them so. So part number one, revisit your withdrawal strategy and possibly consider a blended withdrawal strategy from different types of tax treatment accounts to ensure you have a defined outcome of AGI, adjusted gross income, for the year. Number two, I think it's time for a lot of people to revise their estate planning documents. I mean, good heavens, in light of the increased exemption limits, you got to reevaluate your existing estate strategy. I mean, if you've got trusts that are out there, gifting strategies, legacy plans, you've been doing these things like random acts of kindness and annual gifting and then gifting on steroids, now is the time to make sure you put in place what you need to put in place to message to the ones you love. Number three, I think you absolutely 100% have to plan for legislative uncertainty. You got to ensure that you understand which of these updated provisions are temporary, because a whole bunch of the tax code now is temporary and a number of them are permanent. And you got to make sure your financial plan is flexible enough to adapt for policies that are set to expire, because laws are certainly going to change in the future. And navigating complicated policy documents, I think it's a nearly impossible task for the average person. And if you find yourself feeling the need to take action, but you're unsure of how to do so, I think it's imperative that you consult with a good financial professional that has tax services under their roof, because you need someone that's forward thinking. Remember, it's about being 2 steps ahead. It's preparedness and flexibility. And when you do that, you can put yourself in a position to win over time. And while everybody wants to win big, I always say this: let's control what we can control. And if we can find incremental improvement at the margins every single year and concurrently slate that year after year after year, those small incremental improvements at the margin strung together over a number of years makes a demonstrable difference to your family's security. And when you feel more secure and you know why you're more secure and you understand and have people that deliver strategies so you know how you got more secure, then you self-actualize into something. It's called financial peace. Because when you have financial peace, you live more. But you live more simply because you're worrying less. Everyone's biggest fear, I don't care how successful you are financially, people's biggest fear is running out of money. It's being impoverished. Because for most of us, we know what it was like to struggle. We know what the toil was. And we also know how sweet it is when we've amassed good nest eggs, put ourselves in a position to be successful. Once you've gotten there, you got to make sure you don't lose it. And that's why we talk today about the sequence of return risk. That's why we talk today about valuation and cap-weighted indices. That's why we talk today about what you need to be thinking and doing when it comes to continuity of care planning. That's getting care in the home where you want it and protecting what could be a healthy spouse, healthy partner from ever becoming financially impoverished. And that's why I want you to download those guides. Download those guides from our website, getretiredstayretired.com. Download a short introduction to long-term care. Download now from getretiredstayretired.com, tax opportunities for investors. I want you to understand OBA, the One Big Beautiful Bill Act, and the opportunities it gives you as an investor. And you know what's exciting? This is America. And when you live in America, anything is possible. I just want to make things more probable for you and yours. And that's why we use these sincere and actionable ideas that are TNT, tested in the trenches, to get you into a place of financial peace. Because I don't think you should go alone. And I don't think you should work with an advisor who is alone. I think you need to work with a team of advisors that provide the belt and suspenders, the redundancy, and the expertise to make sure that things are systematic and repeatable. 833-964-PLAN. That's 833-964-PLAN. GetRetiredStayRetired.com. You're listening to Craig Bolanos, in the know, VestGen Wealth Partners, on the station with all the answers. That's why we affectionately call it AM 560. The answer.
Okay, Windy City, get ready to be blown away with a hefty gust of financial know-how. You're listening to In the Know Radio with Craig Bolanos on AM 560. The answer.
You know, we've talked this entire year about why you should have pragmatic optimism. And if you did, even though times were tough earlier this year when we went through a recession, paranoia, you've prospered to the other side. And now you're on the other side of that pragmatic optimism, and it's time to make sure you're diversifying your diversifiers. That means rebalancing, taking some profits, placing monies into various storages of value, because I think scarcity is going to matter. The artificial intelligence revolution is real. AI enthusiasm is real. How long the adoption cycle will take for full implementation, we don't know, but I think the pace of change is going to be incredibly rampant. And I want you to not just be reliant upon the S&P 500 cap-weighted strategy. I want you to broaden your horizons in truly curating that multi-asset class global portfolio, because I think you need it. Because remember, stretch valuations on their own are not a problem. Stretch valuations that get linked to an event of some kind are a problem. And that's the setup that we have. So enjoy the run. Stay long, everybody. Don't go short yet, but make sure you're paying attention and heed what I'm suggesting. Whether you're partnering with infrastructure, partnering with warehouses, partnering with various forms of private credit, partnering with asset-backed, looking at those tax equivalent yields on the intermediate side of the municipal curve that I said, leveling up any of your legacy annuity contracts that were issued at a time that we had lower earnings or lower cap rates. The point of it is now is a great time coming in with 90 days left in the year to reassess you and yours and figure out what it is that you can be doing to do exactly that better, because it's about doing things, and winning isn't a zero-sum game. It's about doing well relative to your own potential. And we're here to help you with that, which is recognize your potential by optimizing all the different facets of what a wealth plan is, by bringing together a multifamily office, a multidiscipline office with all these services under one roof. We would love to hear from you, love to talk to you. 833-964-PLAN. That's 833-964-PLAN. Go out to our website, GetRetiredStayRetired.com. That's GetRetiredStayRetired.com.